our composite of acquisitions. There's 30,000 agents and brokers in America, and I'm very clear about the fact that we're not a roll-up company. We're building essentially a business together with partners who have done well in our business locally. When they join Gallagher, they get a whole composite of new tools. Data and analytics are becoming much more important. The relationship with carriers, what we have in terms of expertise relative to the very verticals they're in, whether it's construction, religious, not-for-profit, real estate, et cetera.
Right.
People want to trade with people that understand their business. So what you've got is these 30,000 entrepreneurs who, by the way, do well. If they combine together, bringing their brain power to what we have, it makes the whole enterprise stronger. And I think our biggest differentiator, frankly, is our culture. We like each other, we work together, we come 100% behind helping a client. And everybody gets that. And so over and over, we buy somebody and they'll say, yeah, I'll be here for about 3 years. I'll sell you the business, but count on about 3 years. And 7 years later, you say, how you liking it? I'm still here.
Well, let's go back to this survey, this annual business owner survey that you launched. You talk about some of the concerns there. Extreme weather, for example, is one. But at the top of the list, I thought it was interesting to see cyber security up there. We were just talking about Victoria's Secret, their cyber issues this week, but it's across every industry, it feels like, these cyber attacks.
So very clearly, I've been saying this now and that's one of the examples of how the insurance industry is so dynamic. We never talked about cyber 15 years ago. I heard you in your previous segment talk about Google. 2020, you didn't know what it was. Today,
2000.
Yes,
sorry.
2000.
2000.
By 2020, I was already.
You were there. Sorry, Matt. But the truth is, if you're running just a little store, bodega, you should be considering cyber cover. And it's that critical to the long-term safety of your company. And people need help with that. What is cyber? What does it include? Well, it includes the help you get after you've had a problem. And that can hit anybody from a small trucking firm all the way up to the likes of Victoria's Secret.
Yeah.
And even if you're Gallagher at 57,000 people and you have a breach, you need a tremendous amount of assistance, and that's a big part of what the product brings. And I think it's good to finally see it making the radar screen, because we've been telling our clients, and there was a time when we were frustrated. We had said to ourselves, every single client will be talked to about cyber, and about 16% a decade ago were buying it, and that's ramping up incredibly now.
It's a great point, too, that, I mean, okay, it's one thing for Victoria's Secret to have a cyber attack and have to deal with it. It's a totally another thing if you're a small company such as a bodega. Running up against the clock here, unfortunately, I have to leave it. Really great to see you, especially in studio. Our big thanks to Gallagher's Pat Gallagher. Now, coming up, Dollar Tree, warning of a profit hit from, you guessed it, tariffs. Details next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks as we approach 6,000 on the S&P 500 again. Right now, 59.86, 59.87, up 0.25%. The Nasdaq gaining about as much as well. A lot of red on the screen for a green day. Crucially, Nvidia is only down 0.1%. Tesla off more than 2% as Chinese shipments disappoint, down 15%. CrowdStrike, we've been talking about, kind of missing its outlook. And then Dollar Tree, we're going to talk about right now. Katie, what do you got?
Let's do that. Dollar Tree warning of a profit drop due to tariffs despite adding more than 2 million new shoppers last quarter. Now, the retailer anticipates a reacceleration in sales to close out this year. Let's break it all down with Bloomberg retail editor Emily Cohn joining us now. So let's compare and contrast here because we got Dollar General yesterday. Shareholders seem to like the fact that they were kind of mitigating and navigating these tariffs. A different story when it comes to Dollar Tree.
For sure. So Dollar General is not your typical dollar store. It's much closer to a grocery store. I think something like 80% of its sales come from consumables, things that you eat. Dollar Tree is much more your classic dollar store. And what that means is that they're way more exposed to tariffs, the stuff that's coming from China. China is its #1 source of imported goods. So that puts it at, in a much weaker spot than a store like Dollar General.
So what do? I mean, do they become the $5 store?
There are some pluses and minuses in this report. I think they're saying that more people from upper income families are coming to shop. I think they probably saw a little bit of a pull ahead of people shopping ahead of tariffs.
But they can't raise prices much, Emily, right? Because isn't the idea that everything costs $1?
That's true. That's
or
true.
Is that
but
not
I feel
the
like
idea?
They've moved away from that $1 price tag a little bit.
They can probably raise prices a little bit. They can probably, like Dollar General, negotiate a bit with their vendors. There's some other mitigation efforts there. But yeah, you can't raise prices that much if dollar's in your name.
That's true. We only have less than a minute left with you, but bring us forward to after the bell today because we have Five Below to kind of close us out here.
Five Below is also in a similar spot as Dollar Tree.
Again, locking themselves in on a price with the name.
A little bit more.
It has to be below five, right?
It's true.
But yeah, we saw in April they turned around shipments of goods coming from China. They're much more dependent on China, and I think we'll be watching for that and how they're planning to mitigate the cost of these tariffs.
All right, Emily, every time a store that sells stuff for only $1 or less than $5, we're going to call you back. Emily Cohn there talking to us about today, Dollar Tree. Coming up in the next hour, Ann Maletti of Allspring sees opportunity in healthcare stocks. We've seen a lot of M&A there this year. We also have the CEO of the jeweler Kendra Scott on the rise in gold prices, and that rise doesn't look set to stop as central banks continue to buy. Plus, Citizens CEO Bruce Van Saun joins us at the desk to give us the look from a bank that operates on Main Street. This is Open Interest. We are 30 minutes into the trading day and pushing towards 6,000 on the S&P.
The moment we've been waiting for. We are looking at bull market territory. They are back. We've been talking about it. The bears are now hiding, it seems like, for now.
Yeah, we're just less than 3% away from an all-time high. That was 61.44, I think we put it at the end of February. And globally, stocks are at an all-time high. So.
Yep, and it's interesting because the yields are lower today on the heels of softer economic data, and it actually
didn't even look yet today.
Like we are looking at even more soft economic data. So we're going to bring in our own Michael McKee to talk about that. We're looking at ISM services looking like it's coming in lower than expected.
It's coming in a lot lower than expected. We're in contraction territory here at 49.9, down from 51.6. This is a surprise. The feeling was that it wouldn't be changed during the month at all, go up just a little bit. The other numbers are not particularly good either. Prices paid rises to 68.7 from 65.1, so you get some inflation at the same time that you get a contraction in activity. Production 50 goes to 50 from 53.7. New orders falls into a big contractionary territory, 46.4 from 52.3, and employment rises just a little bit, 50.7 from 49. So we'll see how that feeds into what we get on Friday. But the interesting thing, of course, earlier today we had the ADP number come in as a big surprise, only 37,000 jobs. Not saying ADP is a great forecaster, but
I wanted to ask you about that.
Low.
And I guess probably 3 or 4 times a year I ask you, hey, Mike, how important is ADP as we head towards the non-farm payrolls number on Friday?
Well, ADP is not particularly important in terms of its overall number, but in terms of the direction, it kind of gives you some information. It might get incorporated a little bit into tomorrow's or Friday's forecast.
But it's not super predictive.
But in April, ADP said there would be 60,000 jobs created, and there were in the private sector, and there were 167,000. So you're not going to get much of a steer from them. But they do get traded on a lot, so people pay attention to it.
All right, Mike McKee, thanks so much for joining us, our international policy and economics editor. And Sonali, I hadn't even checked the yields today. You didn't remind me this morning, and we're below 440 or right there on the 10-year right now.
And it's interesting. The latest data that we just got at the top of the hour brought yields even lower. Interesting to see how this push-pull is going to play out. I know later in the hour we're going to talk about that tax bill. So the long end being lower is kind of interesting with that.
Elon Musk doesn't like it.
Doesn't like it too
apparently.
much, yeah.
And he's pretty important. Also very important in these markets, Ann Maletti. She's the head of equity investments at Allspring Global Investments. And Ann, I got to ask you about the bullishness here. I mean, we've now entered an official bull market, as Sonali pointed out, right? So we're 20% up from the bottom. We're 3%, 2.5% away from an all-time high on the S&P 500. Globally, stocks have hit a high. What's going on? Aren't we worried about the tax bill, as Sonali said? Aren't we worried about the tariffs? Isn't there so much uncertainty?
I mean, there is a lot of uncertainty, and I feel like we've had some overcorrection in both directions, right? We had a lot of fear driving the market to the downside after Liberation Day, and then we've had this kind of what I would call maybe a quick, sharp overcorrection on the upside, where people have quickly gotten comfortable with, yeah, tariffs won't be as bad as we expected in the beginning. But I would say policy uncertainty remains, and there's still a lot of things that we need to work through. So while I, still encourage investors to remain invested, where you are invested, I think will matter. And I like to tell people, you got to be comfortable being uncomfortable because, I think we're going to get a little uncomfortable here.
So what does this mean in terms of where you see the S&P going near term? We were talking about a little earlier, heard you and Katie talking about strategists revising to the upside. But if you think that we have corrected too much to the upside, are you still worried about a drawdown before we revise higher?
Yeah, I will never get timing perfectly correct, right? So whether or not this continues, I don't know. But what I would suggest is that there are places in the market that haven't been that have maybe been ignored more than others, and those are the places where I'd pay more attention to. Focus on diversifying your portfolio and making sure that you're thinking broadly about risk versus reward instead of being in areas of concentration and areas where there's greater speculation.
I want to ask about the tax bill because Elon Musk has come out and really railed against it. You could say, okay, there's a lot of theater, right? These are very dramatic people. They like to get the headlines. They're all about the changing news cycle. But you could also say he got President Trump elected. I'm not sure how right you would be, but he's been incredibly influential,
He's also
right?
giving fuel to the people who want to vote against
Exactly,
this tax bill.
exactly. So you could use Elon Musk as cover to go against Donald Trump. How closely are you watching this?
I mean, I think the tax policy is critically important. You know, there was a lot of focus on tariffs, and it felt like, you know, the market could kind of focus on one thing at a time. It was tariffs, and now it was kind of a slow shift, but now the shift is a little bit more on tax policy. I think, you know, I'm not an economist, but when I look at all of the reports out there, if we don't get a tax policy passed, the impact on GDP is at least another 1%. So it's significant. It's just as big in some ways as the tariff impact, and so to the impact on growth. So it's critical. I think, you know, what we're seeing now is politics in real time and negotiation in real time, and we'll see where that turns out. But to your point of how did we get here, and are we a little bit too frothy based on everything that needs to settle out, that's kind of where my gut is, right?
What are some of the more important parts of the tax bill to you? Ultimately, there's the level of taxes, but then there are the fine-tooth comb details, right? We talk a lot about Section 899, for example, this idea that foreigners...
Maybe not enough.
Yeah.
The revenge tax.
The revenge tax. People are really worried about it, particularly bond investors. Is it something that concerns you?
Yeah, you know, it's funny. I like to take the focus out of what I'm concerned about, because I think one of the best things I can do and investors can do in this market is not put any emotion in what's going on, but say, okay, like, if I take emotion out, what are the equity markets focused on, and what are the bond markets focused on? And I would just say, as an equity investor, I'm a little bit more focused on what the bond markets are telling us here about the potential implications of this tax policy. And I can't ignore that as an equity investor, even though, you know, the market is kind of climbing higher. And so that's where it gives me some pause. And I do think there is real risk. There will be trade-offs, there will be some challenges, and you know, that issue that you point out, I think it's just another point that gets put in the negotiation of, you know, whether it's tariffs or trading, like what's going on in the background that we don't know about.
You know, it's interesting, going back to your thought here on Elon Musk and how he sees the tax bill, I will say the one thing he's not influencing is the bond market. You do have yields lower despite all of the bell ringing that's going on X
but
right
I was
now.
going to say, maybe that is because of Elon Musk. Maybe the fact that he's giving cover to those who could vote against the bill means bond traders aren't worried about Section 899 because it's not going to pass. And that's why we see the 10-year down 7 basis points right now. Ann Maletti, great having you on the program. Thank you so much for joining us. She is head of equity investments at Allspring Global Investments. I want to get a look at some of the single stock movers this hour and kick it off with one that's incredibly important to Shonali and to, I would say, a large base of our viewers. Wells Fargo rallying not quite as much now as it had been, but I think it is I've been using the term biblical, right? Because it's been 7 years that they've been under this cap, and it is now lifted. And Sally Bakewell told us a bank like JPM has grown an entire Wells Fargo since that cap was put into place.
It's absolutely incredible the amount of business they've lost over the time of the cap. They are now unlocked. They are unleashed. But the challenge for Charlie Scharf is really interesting here, getting deeper into investment banking, into trading against the giants. So I would say the competition is on. A fun fact about the price to book value there for Wells Fargo, not only are they about double Citigroup, they're actually more than Bank of America.
We have a chart. I believe Joe put a chart together. This is just the two, Wells Fargo and Citi. You can see Wells Fargo at the top, 1.5 in terms of price to book. Citi only 73 basis points, I think.
Yep.
It's interesting, though, if you put in Goldman Sachs, which is like 170, and then JP Morgan, which is like 2.25, right?
Incredible.
So, yeah.
But
you really got me into these banks, Shonali.
Oh, I'm loving that.
Thank you very much for that.
Anyways, we're looking at CrowdStrike as well. Cyber has been a really interesting part of this market. They have fallen after a disappointing outlook and multiple analyst downgrades. And HPE, what do you call it?
Hewlett-Packard Enterprises
Says after it says it expects a reduced impact from tariffs on its businesses this year. It is up, but only marginally, about 0.1%. Now, coming up, PE power players. We're live from Super Return with Steve Wise, Carlyle co-head of America's corporate private equity. This is Bloomberg Open Interest.
Right now, while the tariffs and Liberation Day got a lot of the headlines, the market forces, the so-called Bob vigilantes, have woken up those to the concern about the growing deficit in the United States. So in the marketplace right now, with a little bit slower growth and some concern, a lot of hand-wringing, the deficit issue is taking the main stage versus the impact of the tariffs. Now, this administration, we can't get too comfortable. There can be a headline in the next few minutes to change that. But right now, the big focus is on rates, and the deficit, obviously, is the current administration is focusing on their big, beautiful bill.
Now, Apollo President Jim Zelter speaking to Bloomberg earlier from the Super Return Conference in Berlin. Carlyle's David Rubenstein expressing the same sentiment last month, saying that tariff concerns are likely to fade from view by the midterm elections. We're going to head back to Berlin, where our own Danny Berger is standing by with another guest from Carlyle. Danny, take it away.
Shonali, thank you so much. That's right. I am here with Steve Wise, the co-head of American Private Equity at Carlyle. Steve, thank you so much for joining. Really great to see you.
Thanks, Danny. Happy to be here.
So, I mean, it is this moment of incredible volatility where you have policy volatility, volatility in markets, but we've done a round trip and then some, and at least public equities. Are we too sanguine about this moment of stress? Are we whistling past the graveyard?
Well, it's an interesting observation. I think I'm a little bit surprised the market is up where it is. The S&P 500 is up over 5% since April 2nd, and EBITDA multiples are close to 15 times, which is really just a turn lower than the all-time highs in 2021 and really all-time highs in decades. And personally, I don't think we have the clarity to be at that level right now. We really look at the data. You know, Q1 was solid. If you parse out some of the inventory noise, the economy grew at 2 to 2.5%. And April and May so far seem reasonable, pretty benign. Inflation's in a reasonable place. I think some people thought we'd have higher inflation from reaction from businesses. Unemployment is in a pretty good place. But there's a lot of noise around shipping data from China, down a lot into ports into Los Angeles, but in some ways diverted to other parts of Asia and still making its way to the U.S. So it's hard to parse through that. We look at the consumer data as well. That's very important. That's been very choppy. Sometimes the consumer's more confident, sometimes it's less confident. I feel like it's really almost following the volatility in the stock market.
I mean, that's such a hard environment to do business in, with the uncertainty being the buzzword, with uncertainty about consumer trying to understand the data. I know you just had a forum where you met with many CEOs. What is the sentiment? What did you hear from them?
Yeah, we just, fortuitously, we had a forum with our CEOs, about 40 of our CEOs just a few weeks ago. I think the reaction back then was, wow, just trying to understand the magnitude and the severity of the tariffs. It kind of caught a lot of people off balance. But in the last few weeks, they've had a chance to catch their footing. I think a lot of CEOs, certainly our best CEOs, have found their footing in this moment. And they've kind of gone through a playbook. You know, the first thing is assessing the risk. You know, for those that have direct tariff risk, what is that and how do you assess it? That's been done. That happened in a few days. Then it's how do you shore up your supply chains? How do you find, get vendor concessions, alternate supplies? A lot of that's been done, and some price increases to the extent you can do it. The third thing that they've done is look at their balance sheet and their liquidity and make sure they can endure, you know, what could be another change to the tariff situation. And it's also a really good time to find a way to cut costs. It's hard to cut costs in really ebullient times, but in times like this, it's an opportunity to tighten your belt. The fourth thing that they've done, and the most important, is staying close to the customer, and seeing what the customer wants and what the customer needs. A lot of our company's competitors had a haphazard reaction to the tariffs and increased prices very quickly, which really made customers upset. A lot of our better companies didn't do that. They talked to their customers, they figured out what was needed, and they're able to take a lot of market share. So that was, you know, hugely important. And the last piece is just investing in their business, being more aggressive and being having their foot on the gas when others are retreating.
That's interesting, because what we've heard from a lot of businesses is now is the time to pause, to not be spending capital, to wait things out. Is that not what you're telling your CEOs to do? You're saying go full forward and now is the time to invest in yourself?
For companies that have a lot of tariff exposure, and that's a very small part of our portfolio, we want to make sure those first things that we said are in solid shape first. But for a lot of our companies, which are service-based, U.S.-only based, which are in technology, they're in healthcare, they're in financial services, they don't have a lot of direct impact. We're asking them to lean in and be aggressive while others are retreating.
So in Carlyle's last earnings, analysts really lauded it as the return to growth for private equity. There was a lot of excitement, but within that, Harvey Schwartz talked about this idea that we're not in a red light environment, a green light environment, but a yellow light environment. What does it mean to grow Carlyle's private equity business in a yellow light environment?
Well, in a yellow light environment, we are leaning into our power alleys. We're leaning into areas where we have strength. That's healthcare, that's financial services, that's technology, that's aerospace, defense, and government services. As you know, our heritage is in D.C. We've got a real right to win in that area. There's a lot happening in national defense and in cyber. We're spending a lot of time there. We're spending a lot of time in healthcare, in medical products, and in pharma, in areas of innovation. And we're spending a lot of time in financial services, where we've got have had really good success, especially in the wealth channel and the democratization of wealth.
Well, Steve, we could do this all day, but I'm afraid we are out of time. Thank you so much for joining. Really appreciate you being very generous with your time. And with Shonali, with that, I'll toss it back to you. That's Steve Wise of Carlyle.
Danny, We appreciate it. That is our own Danny Berger at Super Return. We're going to stick with private equity because Goldman Sachs is embarking on its most ambitious effort yet to offer an exit ramp for investors who've been trapped in buyout funds. Joining us now with the details, Bloomberg's chief Wall Street correspondent, Sridhar Natarajan. You know, it's interesting to me because on one hand, you have firms like Carlyle that are stepping out. They're trying to do deals. KKR spent gobs of money in the market downturn buying new assets. It's not the assets that they're buying that are the problem. It's the assets that they've held maybe since 2021 at the market peak that they have not been able to let go.
And the biggest clue for you was exactly what our Carlyle guest just said, that when you hear them talk about this yellow light environment or a lot of noise out there, that is code for it is a challenging market out there. And that has been the case for a lot of these private equity firms, and therefore has been very frustrating for their limited partners, for their investors, because it has operated in this time-honored cycle of investors will put in money into a private equity fund, get that money out, more money than they put in a few years, and are able to reinvest in new private equity funds. When any one part of that cycle breaks down, then you have a problem. And that's where we are, which is why we've seen this incredible explosion in secondaries.
Look at the chart here. I mean, we're seeing the explosion illustrated on your Bloomberg terminal there, from 26 billion in 2013 to 172 billion now. How much of a slice of the pie has Goldman taken from this?
Well, Goldman has had a big secondaries business. They have about $44 billion of a secondaries business. Off that, the private equity business, their flagship vintage fund had raised about $14 billion in its last iteration. It will try and top that amount for its 10th fund. So let's talk about 15 billion or more. It could still be challenging, but remember that a lot of these secondaries funds in the past used to directly deal with LPs, used to strike deals with LPs. Now what's happening is a lot of the private equity funds themselves, they don't want to sell off their stakes at lower valuation. So what they are doing is going into this new mode of financial engineering with continuation vehicles. So these so-called GP-led deals are becoming a bigger part of secondaries. One of the reports out there says that 60% of secondaries fund right now are participating in these GP-led secondaries than directly with LPs.
What's amazing to me is even in the lack of activity right now, when you see exits, you find this entire industry finding a myriad of ways to do a whole lot of business. Exactly.
Continuation vehicles, why not?
Let's keep that party rolling. Yeah. With that said, I want to ask you about what this all means for Wells Fargo, too. You have a bank that is on the brink of re-entering investment banking or doubling down in a bigger way. One of the main competitors still is the private markets. We know Wells Fargo was early to make a private credit deal. However, how are they going to navigate a market where the amount of competitors are now also rising in the non-bank space?
So let's set the backdrop a little bit for our audience, because what happened for Wells Fargo yesterday, the news out of the Federal Reserve, the fact that they no longer have to contend with that asset cap is a big deal. This finally means that they can get out of the gate and compete with the likes of JP Morgan, with the likes of Bank of America. They were shackled from doing that for the last 6 or 7 years. Now that opportunity is there for them again. Charlie Scharf has been talking about the fact that this is not the kind of environment where you go out all guns blazing. You don't just flip a switch and say you'll get big in everything. But their opportunities really lie middle of the fairway. More in trading, more in capital markets, wealth management, credit cards. They could finally go back there. When they were back in 2017, their assets were about $2 trillion. JP Morgan was 2.7. In 2025, Wells Fargo assets are still at $2 trillion. JP Morgan's at $4 trillion. They have grown their assets by about 60-70%. Bank of America by 50%. Everyone else has grown. Wells Fargo, therefore, has a great opportunity without having to worry about having to fend off these private markets rivals and peers.
It's like falling asleep and waking up in a different land, where JP Morgan was your one competitor. Now you have Citadel Securities and Apollo, too.
It's an incredible story. Sri, and great to have you as Chief Wall Street correspondent to talk us through some of them. Sri Natarajan from the BN side. Tomorrow we'll be back at the Super Return Conference. It's a good one in Berlin, with more, including an interview from Thoma Bravo founder Orlando Bravo. This is Open Interest. Coming up, we're going to take a look at how rising gold prices are impacting the jewelry market. Tom Nolan joins us, the CEO of Kendra Scott. This is Bloomberg.
And I want to pull up a gold chart here for everyone because we're watching gold up over 40% over the past year, bolstered by safe haven demand. Just last week, Goldman advised investors to turn to gold as a hedge against inflation. We're off the highs, but pretty close to them. And Matt, gold might be great if you bought it here at the lows, but if you are buying gold to make jewelry, this price appreciation might look a little differently.
Yeah, absolutely. It can have a real effect on an impact on your business. Let's get a read on how that gold spike, and maybe it's more than just a spike, is impacting the jewelry industry. Joining us now is Tom Nolan. Kendra Scott, CEO. Kendra Scott is a fashion lifestyle brand, continues its brick and mortar expansion, and obviously gold is a very important part of their business. Great to have you, Tom, on the program. It looks like the rise in gold prices may be here to stay. Bloomberg got a great story out overnight about central banks just buying in size, and they don't plan on stopping. So how do you deal with that as a CEO running this business?
I mean, look, there's so much volatility in the market right now. I think the 25-year high of gold was $3,500. We're not quite there yet, but it may be. I think the team's done a great job of hedging on the front end to make sure we have enough inventory on the raw materials and commodity side of things to protect the business, to make sure that we continue to have a high value proposition for our customers. At the end of the day, that's what we care about.
Does it make you force yourself to look elsewhere outside of gold? You look at silver prices, and they have risen over the past year also, but it doesn't look the same as gold. There's more volatility there. What do you want to do with that?
We want to do what the customer wants us to do. So, I mean, the customer said she likes and he likes silver, she likes and he likes gold. So we're pretty diversified across the portfolio.
How does the consumer look to you? And tell us first about your target consumer. So who are you after, and does he or she or do they really feel like spending money right now?
Yeah, I mean, look, I think from a macro perspective, the consumer is in flux. I mean, there's a lot of noise out there. It's a very turbulent, tumultuous environment. Our customer is very diverse. We have my 16-year-old daughter loves our business. My wife loves our business. So does my mom. It gives us a lot of opportunity in white space, but it also makes it challenging because marketing to each one of those people and the constituents is different for each one. So, but we have a very broad base of customers. You know, consumer sentiment, as you all have reported, is challenged right now, but our businesses remain strong. We're up 6% through the first quarter. We're up 40% last year, 40% the year before, considerable EBITDA margins. So,
who are you competing against? I mean, you're not, I imagine, going up against Cartier and Tiffany. I don't know that much about the jewelry business.
You're on the right track.
On the other hand, you're probably not competing with Kay Jewelers and Signet, so who is it?
You know, it's all the above. I think on the higher end, what we have seen with some of the consumer sentiment, people trading down into our fine jewelry business, which is very high quality. But it's everybody across the board, everybody that you mentioned. We only have a 10% national brand awareness here in the U.S. at a considerable size business that we are. So we've got a lot of white space and wood to chop as it relates to letting people know about who Kendra Scott is and who Kendra Scott the person is. 23 years ago when she started this business with $500 at a spare bedroom of her house, has now become one of the wealthiest self-made women in America. So it's a great story to tell. We do a lot from a philanthropic perspective. We just opened our 153rd store. We launched a new brand called Yellow Rose last year. So it's been a really exciting moment for our business today.
You know, to the point that the consumer has been challenged, is there a price point that you find that people are gravitating toward?
You know, 84% of the U.S. population makes less than $150,000 a year. We're very cognizant and aware of that. I think there's a lot of focus on the very high end we're talking about here today, gold prices, diamond prices, some of the commodities. But we really focus on every customer, and they're our boss, right? So the sweet spot for us, our average ticket's right around $100, and we want to have a really high value proposition, and we want to create experiences. In our stores, last year we did 24,000 events, and the large majority of those events were centered around philanthropy. So we're giving back to the community. We're making and buying. Think about when you go buy jewelry or you're gifting jewelry for somebody. It's a memorable, exciting, fun experience. We want it to be that way. So retail has been really important to us. Our e-commerce business is strong. We've got great wholesale partners too.
How have the tariffs affected your business, and what are you doing, by the way? Do you have a war room set up? Do you have a weekly call? Does somebody give you a report every day? I mean,
you know, it feels like since COVID, there's been like a daily war room that we've had to have for the last 5 years. It's just been challenging, but our business has done really well through it. So we're paying really close attention to it. I think the worst thing that you could do is make a lot of big material decisions in time of turmoil. So we're listening, we're paying attention. We're a very nimble organization. Our supply chain has changed dramatically since the time of COVID. So we were really well prepared for it. The team did a great job getting ready for whatever was going to come. And I think the thing that we've all learned is whatever you think is going to happen, you know, it doesn't stick with it. So there's constant change. So I think the team has done a great job of pivoting and listening to the customer and seeing what they want and then reacting to it accordingly, from price point and everything.
A couple days ago, we had a really interesting conversation about the movement away from real diamonds into lab-grown diamonds. And it really made me think a lot about consumer preferences and the change you're seeing from people in terms of what they consider to be great jewelry.
Yep.
What are you seeing?
I mean, the reality is a lab-grown diamond is an actual diamond. From a physical standpoint, it's the same makeup as same carbon makeup that a mined diamond is.
Denali doesn't buy it.
So neither does my daughter, by the way. We were in our store in Soho yesterday, and we were talking about the store. She prefers mined diamonds as well. I think it's up to the customer. We offer both. The price point, you can't argue with, is significantly lower in a lab-grown diamond. And that suits some people, and other people choose mined diamonds.
Well, to her point, the lab-grown diamond doesn't hold its value, right? So if you're looking at it as an asset, which you can, as well as an emotional token of love.
What are emotions, anyway?
Who cares about that? If you're looking at it as an asset, right, it just doesn't perform the same way. That's the difference.
I think so. If you were in the business of buying and then retrading diamonds, that holds true. I think for most people, there's an emotional connection to it. If you're getting an engagement ring with a 1.5 or 2 carat diamond in there, I think some people may not be happy if it's a lab-grown diamond, but what we've seen is that emotional connection and the power that has of that moment in time matters more than the intrinsic value of what that thing would be if the marriage doesn't work out and they're trying to sell it in the aftermarket. So.
Key is not to tell her until then, right?
Yeah.
I say, hey, I got you a 3-carat diamond, and so many people died mining this.
Who knows, actually? Maybe the lab-grown diamond does appreciate in value.
I do think we're so early on this journey as it relates to lab-grown diamonds that could be the case. At the end of the day, it's a commodity. It's still not easy to get or make. There is scarcity value to it, and I think as long as that happens,
needs.
Yeah, but that's true.
Yeah, that's fair.
I'm learning so much about jewelry. She knows
Diamonds,
already.
gold, and silver.
Yeah, well, I learned a lot about it too. And the beauty of when I first started at Kendra Scott, I didn't know anything about the industry. It's been a great learning journey for me for the last 10 years too, which has been great.
Very cool. Definitely a fascinating industry. Tom, thanks so much for joining us on the show. Tom Nolan, the CEO of Kendra Scott. You want to take a look at markets?
Yeah, let's do it, because it's been a fluctuating morning. We are looking at an S&P 500 now firmly up about 0.3%. It was interesting, Matt. We did see a dip lower a little earlier, so that tells me that, yes, generally we're seeing a little bit of bullishness. We're back in that bull market territory. However, it's on shaky ground. We had some weak economic data. That 10-year yield firmly below 4.4%.
What is it? It's June 4th. So it's pretty good timing for your new show, right?
Oh my
that we get into a bull market. Are we allowed to announce that yet? Not yet?
We are. We can tease the trailer, which is out tomorrow.
All right, so we'll watch the bullish trailer tomorrow when we close, hopefully in a bull market today. Let's get a look at some of the single stocks moving at this hour. Dollar Tree lower after warning about a hit to profit due to tariffs. So going the other way of Dollar General because they don't have as much access to or as much inventory of foods and groceries. Apple is getting downgraded over at Needham because of growth concerns in its position in the AI landscape, and then Chart Industries shares, as well as Flowserve, dropping after the equipment makers agreed to an all-stock merger that would create a company worth around $19 billion.
I thought of you this morning. I was going to say, I looked it up. It's really, if you really look at it, it's Chart Industries buying Flowserve. I came prepared with that for you.
There's always a buyer,
There's
right?
always a buyer.
Merger of equal doesn't really exist.
And Chart Industries will own more of the combined companies, but neither of their investors seem to love it yet.
Yeah, well, they don't like, the PR doesn't like to say that. Coming up, we're going to discuss how tariff uncertainty is affecting banking with Bruce Van Saun. He's the CEO of Citizens Financial, so we get the Wall Street look at Main Street next. This is Open Interest.
Thank you so much.
Over on Capitol Hill, the Senate has begun deliberations over President Trump's big, beautiful bill, and Majority Leader John Thune warns changes will have to be made to the SALT part of that legislation. For more, we want to bring in Kaylee Lines, co-host of Balance of Power. And Kaylee, we're also getting headlines from the Speaker, Johnson, saying that Elon Musk is dead wrong when he calls this tax bill an abomination and says it's going to add trillions to the deficit, and that he tried to call Musk last night, but Elon didn't answer.
Yeah, the Speaker said he did speak to Elon on Monday, and he said he would be trying to help Republicans keep the majority, I assume financially. But when he called on Tuesday after this tweet, I guess Elon Musk did not indeed feel like speaking with him after what was multiple posts on social media about the deficit impact this bill could have, which we learn more about from the Congressional Budget Office today, saying that it will add the House-passed bill $2.42 trillion to U.S. budget deficits over the next decade. That's because there's going to be a $3.67 trillion in the CBO's estimation decrease in expected revenues and only a $1.25 trillion decline in spending. And this is the very concern that even some Senate Republicans have, that these spending cuts do not go deep enough and the impact on the deficit is going to be too great, which is why Senate Majority Leader John Thune is going to have some difficulty navigating his majority here with those who want to see steeper spending cuts, with those who actually might want to see the price tag of this bill ultimately go higher, with being made permanent some of the tax cuts that are only temporary in the House passed measure. That, as well as whatever adjustments need to be made to SALT, which Thune at this time is not getting very specific on, are likely to be discussed at the White House today, where Senator Thune, as well as members of the Senate Finance Committee, which is dealing not just with the tax portion of the legislation, but Medicaid as well, are going to be meeting with President Trump at the White House to try to hash out some of these details.
Kaylee, I want to switch gears a little bit, too, because you are going to be speaking with Senator Elizabeth Warren a little later. And while on Wall Street, a lot of people look at the asset cap being lifted for Wells Fargo as a lot of joy and excitement, right? This is a big bank able to return to a lot of business. I do want to point out one of the more harsh criticisms I've actually seen of this from Jeremy Kress over at the University of Michigan online. He said the fact that it took Wells Fargo 8+ years to get its house in order and the Fed never escalated its punishment beyond the asset cap is a damning indictment of the current state of bank supervision. Now, the reason I bring this up is because we are about to see a lot lighter of a touch when it comes to bank supervision. Yep. Elizabeth Warren is kind of a lonely voice in Senate these days, fighting for more regulation at this point, isn't she?
Yeah, she is a minority voice. Granted, she does have a powerful one as she is ranking member of the Senate Banking Committee, but she's using that voice to largely agree with the tweet you just read out, Shanali, which is that she thinks this is an embarrassment, to use her language, of the Federal Reserve here. She says the entire Federal Reserve Board should be embarrassed by this outrageous giveaway to one of Wall Street's most derelict banks. She said the Fed needs to release reports into Wells Fargo from the last 5 years to the Banking Committee for review. We'll see if that happens. I'll ask her more about this later on today, but it does kind of point to an overall attitude shift that Elizabeth Warren is trying to fight against when it comes to banking regulation. Obviously, we have seen a rollback already of the originally proposed Basel III endgame under the former Vice Chair of Supervision, Michael Barr. He is now no longer in that role, and we could see as soon as today the Senate actually making final the confirmation vote of Mickey Bowman as the new Fed Vice Chair of Supervision, someone who is widely seen, especially among Republicans, as being friendlier to Wall Street and someone who will have a more gentle hand when it comes to some of these regulatory issues. So we're watching for that later today. A cloture vote is expected this morning. If that procedural hurdle is passed, Mickey Bowman could be confirmed as soon as this evening, and with it could bring about a new era of banking regulation as Wells Fargo tries to move into a new era of its own now that its balance sheet is not going to be stuck at 2017 levels anymore.
Absolutely. The banks are very closely watching the Bowman era. That is Balance of Power co-host Kaylee Lines. You can catch Kaylee's interview with Democratic Senator Elizabeth Warren coming up at 1 p.m. New York time. Do not miss it.
I hope she asks what what she thinks the most derelict bank on Wall Street is. Because if Wells Fargo is just one, which bank does Elizabeth Warren hate the most?
She's got into very vocal arguments with Jamie Dimon, but interestingly enough, Wells Fargo moving out of things like home lending in a bigger way in the last couple of years and into those Wall Street businesses. But we're going to go right back to Main Street. For our Wall Street beat, we are now joined by Bruce Van Saun. He is chairman and CEO of Citizens Financial Group. Really good time here to really focus in on Main Street. What's happening with the American consumer? How do they feel, and how much do they actually want to borrow at this point? point in time?
Yeah, I'd say surprisingly, the consumer has been resilient through lots of uncertainty, kind of getting whipsawed by different policy rollout by the Trump administration. I think confidence took a dip in the beginning of April when the tariffs were first unveiled, but people still have pent-up desire to live their lives and spend money, and it actually, once we started to see off-ramps, that the worst case for tariffs was off the table. I think confidence has been restored. You've seen the latest consumer numbers are better. I think the next business poll will be better. And so I think the second half is actually setting up to be pretty good.
I wonder about the small business situation even more than the consumer, right? The American consumer is pretty tough to knock over. But when this whole thing kicked off on April 2nd, we got so many emails from people running small businesses who said, like, I have goods on a ship right now. Yeah. I don't know how much they're going to cost when they get to port. And the small and medium-sized businesses are like, I think 80% of the CapEx or 80% of job creation in this country. So how are they doing? You service those small businesses.
Yeah, I'd say it's a little tougher there. So certainly bigger companies have more diversity of operations and they can withstand some of these shocks to the system better than smaller businesses. But again, seeing kind of the off-ramp coming, one other thing I would point out is that we've been through a really tough period the last 5 years. So we had the pandemic that companies had to deal with. We had runaway inflation and the Fed raising rates very aggressively. Now we have the introduction of tariffs. I think businesses have become very resilient and very adaptable, and they do scenario testing. They try to think through, how do I have multiple supply chain scenarios so that I can deal with what comes down the pike. So yeah, it's been challenging in the here and now, but I think most businesses we're finding are still having reasonably good years and are optimistic about what's going to take place later in the year.
Do those businesses really need lower interest rates at this point? You've seen rates stay at this level generally for a while now, and things have held up.
Yeah,
so
like
what do you feel about the need?
A lot of businesses locked in lower cost financing over the course of the last 5 years. So they've got their balance sheets in pretty good shape. And so I think that hasn't been a big worry.
I wonder about the level of tariffs because a lot of I guess, pragmatic business people come in here and say, look, if we get 10% as a baseline, that's okay, especially if we're getting the tax cuts and incentives to go along with that. On the other hand, I was thinking about this yesterday. 10% is European tariffs on U.S. cars, and it's been enough to effectively lock out U.S. manufacturers from the European car market. So how much is too much?
Yeah, it's a good question. I think the Trump administration is playing for some long-term gains. I'm kind of excited by the fact that some countries are now saying the end game should be let's lower tariffs. That's what Europe is saying. We should have lower tariffs going both ways. Let's negotiate towards that outcome.
That's true, but this president wants to have tariffs to replace tax
I don't know.
revenue.
Like is that the primary objective? He wants fairer trade. So India's making that proposal as well. It would be good if we can reach a harmonious outcome with our friends and then actually isolate China as the last big nut that has to be cracked. So anyway, I think you're starting to see some steps in that direction. But again, I think the tariff thing will resolve itself. The worst case outcomes are off the table. The market is looking forward to tax and spend bill passing, towards regulatory nominees being confirmed, the deregulatory agenda moving forward, pro-energy policies, pro-business policies. There's a lot of pent-up demand to do deals. Private equity has to recycle capital. So again, I'm staying optimistic, cautiously optimistic about the second half of the year.
What about the tax bill? You look at the Congressional Budget Office saying that the tax bill would add $2.4 trillion to the deficit. You have Jamie Dimon warning about a crack in the bond market. A lot of concern about the longer-term interest rates that we're seeing that have close ties to a lot of American financing, mortgages and otherwise. Yeah. How concerned are you?
Well, I think extending the tax cuts is something that had to be done. I think the amount of spend in this bill is less if the Republicans stay unified than if they crack, and then they have to go to the Democrats to get the bill passed to extend the tax cuts. So, it's not ideal, but the legislative process is messy. I think we can absorb the spending that's in this bill. I think the administration thinks that they can grow their way out of some of this deficit by faster growth. So that's the play right here, is to try to create the conditions that the economy picks up its growth rate, and then all these debt to GDP ratios fall back into line.
Bruce, we are so lucky to have you today. It's very interesting. A lot of investors really banking on that pro-growth part of the story. Let's see if we see it. That was Bruce Van Saun of Citizens. And it's Countdown to Bullish. My upcoming series for Bloomberg Originals is coming soon as the S&P nears a bull market. We're going to talk a little bit more about that. Excited to bring you those guests on this show soon. Stick with us. This is Bloomberg Open Interest.
Let's get a quick check on the markets. Right now, looking at the S&P 500, 59.81, 59.82, so up 0.2%. We are back in a bull market now, coming back 20% from the lows. If we close there, it's going to be perfect for your new show.
Yeah, bullish just in time for bullish. But, interesting to me still is that you have a little negativity, too. You have worries in the dollar still, worries about the fiscal situation. You're not seeing that in the bond market, though, today either. That 10-year lower.
Yeah, absolutely. Worries about deficits. And I think people aren't as concerned about a 10% baseline for tariffs as they should be. The damage that did to the U.S. Car manufacturing industry in Europe is maybe irreparable. So I think something to watch.
The big moment of the week also still jobs on Friday. But tomorrow we have a great lineup for you. We're going to talk to Morgan Health CEO as well as a group of investors. Stick with us for that. This is Bloomberg Open Interest.